Hello, everybody, and welcome. Welcome to our webinar today, which is Navigating Provider Relief Fund Reporting. I'm Linda Scafiro. I'm a partner here at Brinker Simpson. Been here for a little bit over 11 years, and my focus here is on attest services, also tax compliance and consulting. I work with many different clients in different industries, but have a concentration of healthcare entities and nonprofit organizations. Our presenter today is James Trubenbach-Byrne. James is an audit manager with our firm. He joined us last October. He left a larger firm to come be with us. He has over 7 years of experience working with governmental, nonprofit, and healthcare organizations. James has a lot of audit experience. He has performed he's worked as an independent auditor. He also has done consulting work with internal control for his clients and has performed audits for state and federal agencies. James also holds a certification, intermediate certification, single audit from the AICPA. So James, do you want to take over?
I'll get started. Just a general disclaimer, we're not providing any tax or legal advice today. What we will be going over is just our general recommendations based on our interpretation of the guidance and research we've done on the topic. Just some general notes. Please use the question and answer box to ask any questions, as we might not see any questions asked in the chat section. We will be going through all the questions posted at the end of the presentation. Once we conclude the presentation, we will be emailing the slides to all participants, along with a copy of the reporting template, which we will be covering. Please refer to our website, brinkersimpsoncares.com, for additional information, as well as any updates that come through after this webinar will be posted there, as well as follow us on LinkedIn, where we will be providing daily updates, and our LinkedIn address is provided on this slide. Just our general agenda for today. We will be covering kind of the background information on the Provider Relief Fund. We'll be going through qualified expenses and some of the areas where it's a little bit more gray, and we have gotten some FAQs from HHS. We'll go through lost revenues and what that means. We'll go through the reporting template and what it looks like and how it relates to how you'll ultimately be doing your reporting to HHS. And then we'll look at the single audit considerations for those entities that are receiving more than $750,000 of funding. So some just background information on the Provider Relief Fund. It was signed into law as part of the CARES Act on March 27, 2020. The fund itself is approximately $175 billion, with some additional money that was allocated after the fact, and it was set up to provide financial support to providers impacted by COVID-19, either through having additional expenses to meet COVID-19 preparation or to prevent it or to take care of cases, as well as to address the declines in revenues attributable to the coronavirus. The Provider Relief Funds being administered by the Department of Health and Human Services. Payments began being issued in April 2020, with payments continuing now into 2021 through either general or targeted distributions. There's been various guidance throughout last year and this year from HHS. However, they have a post-payment notice number 5 that was issued on June 11th that supersedes all prior guidance. So our presentation today will focus on that. And as you look with any questions, take a look at that notice, as that will be the one to utilize. Post-payment notice number 5, in terms of necessary expenses, they're going to define that as cost to prevent, prepare, and respond to COVID-19. So as we go through our slides on expenses, keep that in mind as the general definition. And then their general definition for a decline in revenues is lost revenues related to COVID-19. And one change to point out, based on this notice number 5 compared to previous guidance, is that your lost revenues will now be calculated on a quarterly basis instead of an annual basis. Reporting wise, just to point out, if you have received less than $10,000 in a period, you will not have to do any reporting in that period. So each period that you received over $10,000 in funding, you will be reporting on the HHS portal. Our next slide will kind of go through what the reporting periods mean and when to report and what periods to report on. And then just one general note at the end. As you go through and do each reporting period, any funds that you receive that you weren't able to utilize for that period within the prescribed time frame will be due back to HHS within 30 days of the end of the reporting period. So in terms of dates of reporting, period 1 is what we are currently in. Period 1 is for providers who receive funding from April 10th, 2020 to June 30, 2020. You have between now and September 30th to finish reporting on the payment received for April 10th, 2020 to June 30, 2020. As you do your expenses and your lost revenues, you can apply against any lost revenues or expenses starting from January 1st, 2020 up until June 30, 2021. As you continue with the reporting periods 2, 3, and 4, you'll note that June 1st, 2020 always remains the period that you start with. So if you do go through the calculation now and you have extra expenses left over that you have in addition to what you're reporting in period 1, those do carry over to future periods. If you are short, however, you will not be able to carry that forward. That will be due back. Just to point out, for period 1 for unexpended funds, the 30 days from September 30th would be October 30th, 2021 to return the funds. So qualified expenses, again, to point out, these are costs necessary to prevent, prepare for, and respond to COVID-19. These will be recognized on the same basis of accounting as your financial statements and your tax returns. This is very important for this next line where you have to incur the cost by the end of the period of performance. If you are a cash basis taxpayer, that means you would have had to have paid those expenses to claim them. For your accrual basis companies, you can have them accrued but not paid as of June 30, 2021 to take advantage of those. HHS includes within incurred as part of their frequently asked questions, items that you order that are on backlog, such as personal protective equipment or large pieces of equipment that have been ordered but not yet received. You will be able to claim those if they were ordered prior to June 30, 2021, and you are an accrual basis company. All your qualified expenses must be in accordance with HHS guidelines for the provider relief funds. And as you report your COVID-19 costs incurred, they must be reported net of reimbursement from other sources, such as your PPP loans, your employee retention credits, any additional funds received from insurance or funding sources, and private grants. And then we recommend, just as a general best practice, when we say to report them net of reimbursement from other sources, if you do have the capabilities within your financial reporting software, you should set up provider relief as a separate department or funding source to ensure when you do allocate the source costs that you don't allocate a source cost in excess of the original cost. So in QuickBooks, this would be your class function and MIP. You can set up a funder code. This kind of is an extra step that will allow you to identify anything that was recorded twice.
James, I have a quick question.
Yes.
So under net of reimbursement from other sources, so what would be an example of additional funds received from insurance?
In this case, if you were getting any kind of business interruption insurance that covered when you were closed, you would net that against any qualified expenses to come to that.
Okay, so for instance, a loss of income policy?
Yes,
Okay, great, thank you.
you're welcome. So on here is from the frequently asked questions that HHS provided, the definition of what they consider expenses attributable to coronavirus not reimbursed by other sources. We'll kind of give you guys a general definition outside of what HHS is giving here. So some of the common things we've seen be claimed are supplies. So within supplies, you have medical supplies, personal protective equipment, cleaning supplies. You have information technology, so that would include the cost of additional servers or computers that were purchased to transition to a telehealth environment. One thing to point out with HHS guidelines here is you don't have to take the depreciation value of something like a server. You will be able to claim the total cost on your reporting now instead of only a portion of it with depreciation. Also included, if you look at your facilities, any additional cleaning costs you had to maybe bring in a cleaning crew bi-weekly or every other day, instead of if you had it maybe normally once a week. Any sort of upgrades you had to do to the building, such as upgrading your HVAC to be able to have a negative pressure unit, or if you retrofitted a temporary space to be a COVID-19 unit, all those kind of costs would be included as things you can claim for reimbursement. Equipment, even if it was not used, if it was purchased and put in to your inventory to use, such as ventilators or additional beds or other kind of equipment, it didn't have to be used if it was available to be used to prevent or to provide care potentially for COVID. Those costs would be allowable. And just in general, even if you have subsidiary units and the parent company has all the expenses and it's pushing costs down to different subsidiary units, an allocation would be allowable. We would recommend, if you're doing a parent and allocating down COVID-19 costs to subsidiary units, to have a basis of allocation that is standard and kind of supportable. Don't just allocate to entities that have PRF funds or these other COVID funds. Do it equitably across all units. That way, if someone did look at your allocation, it would be deemed reasonable. One special consideration, sometimes we see that funders are under Medicaid, Medicare, and they're not under a fee-for-service arrangement. Instead, they're on a cost reimbursement arrangement. You see this often if you have a state grant, where sometimes it may either be partially fee-for-service and partially cost reimbursement. You'll have to split out what is your normal cost reimbursement claims versus your additional COVID-19 claims as you do this. Similar to what we said with provider relief, the best way to kind of track this would be if you set up a separate department or a separate class code to track what is your normal cost reimbursement claims versus what is the additional expenses you're incurring because of COVID-19. Personnel costs. So costs for your direct employees, whether full-time or part-time, contract labor or temporary workers, are all eligible expenses that can be claimed if not reimbursed and covered by other sources. Along with the direct costs, you are also able to claim the fringe benefits associated with those payroll costs. One thing to point out here is that you are able to claim administrative employees even if they didn't provide direct healthcare services to patients. The caveat here is that HHS wants you to only charge administrative employees to the extent that time was spent on COVID-19 specific matters. We recommend in this area that you document how you determine these administrative employees spent time on COVID-19 specific matters. Some ways you can do this are timesheets where they say, I've spent 25% of my time on COVID-19, 75% on administrative time. An effort report, you can do that after the fact if you didn't do timesheets for that period. and just document, here's how much time was spent on, again, COVID-19 versus your general administrative time. Have the employee themselves certify that and have someone, a supervisor, or in the case of if it's your executive director, have the board possibly sign off on that, or just have a general documented policy. So let's say your executive director for March, April, and May, when we're in the thick of things with COVID, spent all of their time on COVID-19. Just maybe do an internal memo and document that this was their entire focus, and that's why we charged 100% of the cost for that period. Just so when someone comes in, whether it's your outside auditor or HHS, there is some sort of policy in place that did document how you came up with that allocation. And then within HHS guidelines, they also have a cap on the amount of payroll costs you can charge for one person. This is based on the direct cost and not the fringe benefits, but for any employee, you can't charge more than $197,300. This cap is prior to any costs that you will be netting that were reimbursed by other sources. So for this example, if you had an employee that made $200,000, that person would first be limited to $197,300. And then if you received a PPP loan and you took some of their salary against that, you would then apply it against the $197,300 to determine the cost you would claim for provider relief funds. And then just in general, the time you do allocate to charge for an employee cannot exceed what was paid to the employee. So again, the best way to accomplish this is come up with your source costs. So when you put the payroll register itself in your financial reporting system, if you do use some sort of fund code or class code within your financial reporting system, this will allow you to allocate it and ensure that you don't go over that original source cost.
Okay, and at this point, I just want to remind everybody that all the qualifying expenses have to meet either preventing, preparing for, or responding to COVID-19.
Here's some more additional frequently asked questions that HHS has received. So just to kind of summarize this, some of your additional pay sources that you may have would be includable in that hazard pay, any sort of supplemental pay, additional benefits provided to employees, combat bonuses. Those are all considered necessary COVID expenses because you would not have incurred those without COVID-19. One item to point out that would be new on your payroll system that you would not include would be your FFCRA credits. So those are money you pay to employees as a result of them getting sick because of COVID-19 or having to stay home and care for someone with COVID-19. Those would be reimbursed as a tax credit. So those aren't going to be includable when you do your PRF calculation. And then in terms of outsourced services, this is a great area to keep an eye on if you're looking for qualified expenses. A lot of companies we've seen do have additional outsourced expenses because of COVID-19. One client I had telehealth where they haven't used a certain vendor in 3 years. And now when they moved to this telehealth environment, they brought back on this consultant and they're paying them approximately $20,000 each month. So in that aspect, it was very clear that that expense was directly attributable to COVID-19 because they had not been using them for 3 years prior to this. So keep in mind that any sort of outsourced and third-party vendors, to the extent they are helping expand healthcare capacity, would also be reimbursable expenses for provider relief funds. And then the last area here where this is probably the biggest gray area is rent and mortgage payments. Here's the frequently asked question and the response from HHS. What we take this to mean is an example of a qualified expense would be you rent additional space to expand your capabilities. So an example of this would be normally your general administrative personnel or on-site at the facility, but in an effort to expand the actual square footage and available space within your facility, you moved those general administrative people out into a different space that you rented. In that case, we would consider that an allowable expense because you're expanding the facility itself while also possibly protecting and slowing the spread by having less employees on site. That doesn't necessarily preclude you from taking the rent and mortgage payments, but we would recommend if you are going to take additional rent and mortgage payment, you document your rationale and how you determine that the rent or mortgage payment for your traditional facility was incurred to prevent, prepare for, and respond to the coronavirus. This way, if you do have a documented policy, it's a little bit easier if it was challenged in an audit to stand up. But again, this is one of those areas where we find it a little tough to say your traditional mortgage payment on the facility was an expense incurred to prevent, prepare for, respond to coronavirus, since it was a normal expense anyway.
James, so staying with the admin personnel. So in the bookkeeping office, for instance, if you put in plexiglass or you incur costs to socially distance the employees, that would all be deductible, or that would be qualified expenses, correct?
Yes, any improvements generally to the facility would be includable. In the case of administrative employees, by keeping them healthy, you're also keeping your healthcare staff healthy. So I would say that would fall under preventing coronavirus itself if you do have your administrative people still in your facility. So now we'll look at lost revenues. Just to point out real quickly, the third bullet point, you only have to look at lost revenues for the reporting period if you have not fully expended your PRF payments on healthcare related expenses. So as you do your reporting for period 1, it's possible you will not have to do the lost revenue calculation just yet. So lost revenues will be claimed to the extent they are related to COVID-19. These are going to be limited to net patient care revenues. We'll go over what the definition that HHS provided for net patient care revenues on the next slide. Just to point out, one caveat with lost revenues is that you can't claim those for any nursing home infection control payments. Nursing home infection control payments must be claimed with qualified expenses. You can't use lost revenues to account for those funds. And then just another note, when you do your PRF reporting, those nursing home infection control payments will also be reported along with that in the portal. Lost revenues are now calculated on a quarterly basis based on post-payment notice number 5. Previous guidance said to look at it for the year in total, and now they're saying do it on a quarterly basis. And then any quarters that do have a gain, you will not have to offset those with a loss. So if you look at quarter 1, 2, and 4, and they all have losses, but quarter 3 had a large gain, you would not have to offset that gain from quarter 3 against the losses of 1, 2, and 4. So that was one good thing that came out of that post-payment number 5 is it should help alleviate some of the extra pressure on coming up with either lost revenues or expenses with the payments received. So net patient care revenues. So HHS is considering these any healthcare services and supports as provided in a medical setting, at home or through telehealth or in the community. These will be reported net of any contractual allowances. And for rental payments, those resident fees for nursing and assisted living facilities would be includable there, but you would exclude real estate revenues if they're generally unrelated to the facility itself. If it's just ancillary, let's say you rent out a space in your cafeteria to a vendor, those would be excluded. Other things excluded would be any sort of grants or tuition received by the entity, any charity care adjustments, bad debt, and gains and losses on investments. As you go through and you have any sort of claim settlements, try to ensure that if you can tag them to a different account if they relate to the period outside of 2019 through 2021, as any ones outside of this period would not have to be included within your calculation. And again, to point this out, as you have grants and recoveries that were received related to COVID-19, be sure to offset these against any associated COVID-19 expenses you are claiming. So for the lost revenue calculation, there are 3 options provided by HHS to calculate this. There's the actual to actual, actual to budget, and the alternative reasonable methodology. Once you select an option, that along with your accounting methodology should be applied consistently across the periods. So any sort of calculation you do to come up with a charity care adjustment, let's say, should be the same methodology across all periods. When it refers to actual, it'll always mean the corresponding 2019 quarter. So if you're doing actual to actual, you would look at the results for quarter 1 20 versus quarter 1 19. And then when you do 2021, it'll also be quarter 1 2021 against quarter 1 2019. For option 2, the actual to budget, this option's only available if you had a budget approved prior to the CARES Act passage on March 27, 2020. And then for the alternative reasonable methodology, when you do this method, if elected, you do have to provide a detailed narrative description of this methodology, as well as keep the supporting calculations for this to upload into the portal. Methods 1 and 2 are going to be your 2 simplest methods, with number 3 being a little bit more difficult, as you do have to come up with the methodology on your end. One caveat we will give with method number 3 is you're not going to really know if the method was accepted until if DHS or did audit it, then you would find out if they found it to be reasonable or not. It's unclear if they came back and said that methodology wasn't acceptable, if they would allow you to go back and retroactively claim under 1 and 2. So if you do elect that 3rd option, we would recommend to first see if you get to the same point under option 1 or 2
Be prepared.
of forgiveness. And then if not, if there's a big discrepancy and going with method number 3 would allow you to spend down all your funds, then you could consider it. But again, be prepared in the case that if you do option 3, there is the possibility they could come back at a later date and disqualify that. So if it's very close between option 1 and 3, consider just doing option 1, because in that case, it's a little bit less exposure.
Right, easier to defend.
Mhm.
And James, for every reporting period, you have to elect the same method.
Correct,
You
yes.
can't switch from actual, then the next reporting period go actual to budgeted.
Correct, yes. So in that aspect, it's a little tough with actual to budget, because a lot of organizations don't do 5-year budgets and annual budget.
Right. Yeah.
So that would make it tough in terms of reporting that way. So here's the URL link here where to access the portal provided by HHS. Any providers that have not pre-registered for the portal should do so now, prior to your actual reporting. There's no real timeline of when you have to register for. However, we would recommend, if you are required to report in period 1, you do so at least a week prior to that September 30th date. Like most things, there's probably going to be a mad scramble at the end. So you don't want to have a hang up where you're not registered for the portal just yet and you can't access it and you missed that reporting window. So we'd recommend doing that as soon as possible. It only takes a couple minutes to pre-register. And the other good thing about registering for the portal is any sort of new notices or updates they do have with Provider Relief Fund, they will push out to whoever is associated with the account on the portal. So they will be proactive in sending you notices directly. HHS has provided a reporting template on the website, which we'll walk through, and we'll also provide a copy to that will mimic the actual reporting inputs. The reporting itself will consist of a combination of financial and non-financial data. The non-financial data itself, you'll probably need to look outside of just the accounting system and accounting department to pull this all together. These will relate to personnel metrics, patient metrics, and facility metrics. As we go through the template, we'll stop on that section and kind of walk through what the different non-financial information that you'll need to pull together is. We just recommend, prior to looking at and completing the template, to go in and kind of get yourself organized with reporting from the system. The first thing to do would be to identify your actual provider relief payments received by date and amount to determine when you're going to have to report and if you have to report. The second thing we recommend is to generate the reports from your financial system that identifies by quarter for 2020 through the second quarter of 2021, your COVID-19 assistance received outside the provider relief fund, your expenses incurred as a result of COVID-19, and your net patient service revenue by funding source. So as we go through the template, you'll see they do want it disaggregated by funding source for revenues. We would recommend that you reconcile your expenses incurred that you're going to claim on PRF versus those for outside awards before you do the template. That way you ensure that you're reporting it net and not gross. And then just a reminder that if you go through your lost or your expenses attributable to PRF and you are short, then you will look at the lost revenues. But if you do have sufficient expenses for that period, you're not going to have to pull as much detail for the lost revenues.
So if you're not using lost revenues, you don't have to prepare those calculations? Is that a true statement?
You will have to give the totals for 2019 and 2020, but you're not going to have to go in as granular by quarter. They just say, what was your net patient service revenue calendar year 2019 and calendar year 2020 versus the full detail by quarter. So you would be able to save yourself some time in completing your reporting. For those that do have to complete the lost revenues, you're going to want to generate the reports from the financial system that identify it by quarter for quarter 1 2019 to quarter 4 2019, as these will be the base year for revenue. Even when you do the alternative reasonable methodology, you will have to input numbers from 2019 as well. If you are going to use the budget to actual method, make sure you have a copy of that budget handy and you keep that in your records, and just double check to ensure that it is somewhere documented either in board minutes or on the budget itself that it was approved prior to March 27, 2020. And then we would recommend looking at the various options on the quarterly basis with this to see which one's the most beneficial. And again, if you don't have to use option 3, and you could use option 1 and get to the same result, we would recommend using option 1 or 2. With 3, you will have to have your narrative ready to upload with the reporting package. And then again, a reminder, with the latest guidance provided by HHS, those periods with a positive variance year over year do not have to get netted. And then one more thing to point out when you do the reporting, it's not going to tell you whether or not you've expended all of your funds through the lost earnings calculation itself. So you're going to have to come up with how much is the lost earnings for those periods and compare it to also your lost expenses and your provider relief funds to identify if you have any unspent funds to remit within the 30 days of the reporting period, which would be October 30th, 2021.
Right, and I assume, I know with my clients, almost every one of them is required to report for period 1.
Mhm.
So I think probably most of the people on the webinar here are going to have some reporting that's due again by September 30th of this year.
Mhm. Here's just a screen grab from the HHS website of the portal. Here's where you would click to go in and register for the portal. And then as well here on the website, if you scroll down further, you'll see where to download the portal worksheet. On our end, we will be sending out a copy of the worksheet and we'll walk through that now. But just in general, here's how you could access it separately.
There we go.
So here we have the first tab. This first tab is going to mimic what we had that slide earlier, which shows the date you received the funds versus the reporting time period. One thing to point out is that HHS has from their system the amounts and dates of the payments. So you're going to have to go by their dates. So it's also worth noting, compare what your general ledger says against their reporting period. And anyone that did return funds, their system would show any returned funds already net against what you received. The first tab here is going to be the other assistance received outside of either provider relief funds or infection control payments. So just to walk through what some of these are, the first thing is up here, you'll see it is by quarter again, starting with Q1 2020 through the second quarter of 2021. The first items here are any kind of funds received from the Treasury or SBA. These would be things such as your PPP loans, if you did get an EIDL loan or advance, or any employee retention credits, they'd go in this section. Those receiving any funds through FEMA would put the funds in this section here. Any additional funding received for CARES Act relating to COVID-19 testing would go in this section here. And then the local, state, and tribal government assistance goes here. This is a little bit of an area that could be gray. So keep an eye on this if you're an agency that gets funded indirectly through a state or local government grant. If you did get any sort of additional payments from these entities on top of your normal reimbursements, take an eye on or take a look and see if these were related to COVID-19 response and if they would have to be netted against additional expenses. Also, there's a possibility that you would receive pass-through funding for additional single audit programs such as coronavirus relief funds. If you did receive those, there's potential that that would have additional single audit implications that we'll cover later. So this is somewhere you may have to dig a little bit more into detail on the actual payments themselves to see what they related to. Any business interruption insurance that you received, you would report here. And then finally, this would be any sort of other assistance. What we've seen in practice is this would be any sort of grant you got from outside agencies or from foundations that were used, let's say, to buy personal protective equipment or buy additional healthcare equipment or possibly buy your staff lunch. Those sort of costs would go into this bucket here.
And that would include grants from private foundations?
Yes.
Okay.
Yes, they want you to net, as well as your government sources, they also want it net of any private funds received.
But it would only be grants that were given to address COVID-19?
Correct, yes. Yeah, anything that's utilized that was directly related to COVID-19 expenses. In terms of your expenses, these next three tabs here below is where you'll report your expenses for the period. We'll start on the first tab here, which is your infection control payments. Again, with infection control payments, you can only claim expenses against this to get the full forgiveness on those funds. You can't do lost revenues. So they're going to have you carve out those expenses first from your normal provider relief expenses on this tab. So as you go through, there's two areas to report. Those reporting less than 500,000 would report in this table when they do the calculation, and those with greater than 500,000 will report down here. What we would recommend and what I traditionally do with clients is we actually fill out table B first to come up with our categories of expenses to match what we're claiming. We come up with the total and then move it up so that we match the categories here. We're not going to give the detail on the actual reporting, but then at least we match by category. And then one more item to point out is as you go through, anything that's not going to have a value is going to be a 0. So if you go back to the assistance tab received here, if you didn't have any FEMA programs, make sure you populate this with this as a 0 because you will get errors when you do the online reporting if it doesn't have a value.
Right, so just to impress that every cell
Has to have a
has to
value.
have an entry, a value.
Yes. So this would be your infection control payments. The next piece here is what you're claiming for the provider relief fund itself. Any amounts you report here will be net of A, the other assistance received, and B, the infection control payments. It's going to be similar to that other tab, and those with greater than 500,000 have to report it in detail, and those with less than 500,000 will report in this table. One thing to note is that the system will only allow you to claim up to the amount of the funds received in that period. So for our example here, we have 1.65 million in total expenses. Let's say you had 2 million of expenses to claim, and that was the total amount of your payment received. You would not report those other $350,000 on this tab. It would go on this unreimbursed expenses tab. So you're going to complete this up to the point of your payment received, and then you'll go to your unreimbursed expenses tab. What this does on HHS's side is as you continue to report into periods 2, 3, 4, those expenses will continue to be claimed, and they're going to move from this tab onto the other PRF payments and be claimed.
And the system will.
We'll see how it goes, but that way they know that everything, here's everything for the first 4 quarters of 2020 and those 2 periods of 2021.
Mm-hmm.
And then it's going to continue to roll forward is the expectation here.
Okay.
When they do open it again for period 2.
And I know you mentioned this before, I just want to make sure I understand. So the amounts that the providers have received are going to be already in the
Yes.
on the portal.
Yes, they'll have it directly linked. And if you do try to claim more expenses here, it will flag it as an error. So if that happens and you're midway through quarter 3, just enter up until the amount of the expenses of that money and then start inputting it on this unreimbursed tab here and then continue going to the right. For those that were able to claim the funds with with only expenses, you're going to fill out this actual patient care tab, which is again your net patient service revenues for 2019 calendar year versus 2020 actual calendar year, and that's it. There's no need to do a more thorough calculation or do a quarterly basis. For those that go on to doing the lost revenue calculation, you're going to choose the tab applicable to the option you're selecting. So option 1 here would be actual to actual. Option 2 is budget to actual, and 3 would be the alternative reasonable methodology. You will select it in the portal. So the other 2 options, you won't have to fill in all zeros. To point out with 3, again, you'll fill out the information and attach this narrative, as well as you should have the calculations behind it ready in case of audit. Looking at option 1, which is probably going to be the most common, you're going to input it by each year. So here would be your 2019 quarter 1, 2, 3, 4, and then continuing across through into quarter 2, 2021. You're going to break it out by major section, such as Medicare A and B, Medicare C, any sort of Medicaid or children's health insurance, your regular commercial insurance payments, self-pay and other. Within other, an example of something that would go in there would be your resident fees, if you are in assisted living, would go in this area, or if you do receive any sort of payments from a local or state government related to fee for service that aren't directly Medicaid, Medicare per se, would also go into this area. And then option 2 is similar to option 1, except that you will put in what the budget was versus the actual. Going to your non-financial data, just to point out, the non-financial data and your actual patient care revenue, these aren't going to be used to offset any sort of forgiveness that HHS is going to give you. What they're doing here is they're trying to collect as much data as possible to see the overall capabilities of the healthcare system as a whole. So they want to go forward, be able to understand if this happens again, what the capacity is for our healthcare system and how quickly we can pivot. So fill in this information to the best of your ability, but this will not be subject to audit if you are single audit. Just make sure it's as close to the information as possible. The first item here is your personnel metrics. So here you'll give the full-time, part-time, contractor, and furloughed employees. What I've done with my clients is we report it as of the quarter end for these periods instead of trying to come up with an average in this area. And then the other way we determine reasonableness is we did a sort of reasonableness calculation where if we had, let's say, 100 full-time employees here, and now we have 105 here, just to kind of do a general recalculation and see that, okay, we knew we had 5 separate employees and then we hired 10 more. Does that make sense now that we have 105? In this case, it would roll forward to 105. So we were pretty sure that it was reasonable.
The template doesn't do the math for you.
It does not, no. We just did it as a general check to see the reasonableness by
Makes
rolling it
sense.
forward.
Sure.
The next piece here is your patient metrics. Again, to point out here, this template is for all providers. It's not specific to any one type of facility or any provider. This will be anyone that's reporting is going to use this. So some of these categories may not apply to you. So in that case, don't be afraid if you are putting zeros across, it may just not be applicable.
So for instance, the dentists and the doctor's offices, they're not going to have admissions.
Correct. You would, and also you may not see emergency department visits in that case, unless you have some sort of extra.
You were probably in lockdown.
Yeah. For this area, we're recommending taking the totals for that period. So going all 3 months in Q1 2019 of inpatient admissions or your out of patient visits. Just to point out, number of facilities, there's a good chance if you're an assisted living facility, this would be ones all across. Where I've seen this differ is if you have one facility that may do outpatient visits and you also have some sort of supportive housing that provides medical services in home, and you may have either opened or closed locations because of COVID-19, you may see a fluctuation in the number of facilities then. But you would probably not see a fluctuation if you are just one assisted living facility. It'll just be one all the way across. And then for facility metrics, we've been reporting on an average basis here. So just the average number of beds available. Just as some general guidance, if you're going through and all of a sudden in Q1 or Q2, you have less beds, that would tend to make sense if you are a facility that all of a sudden you had 100 beds, census dropped to 50, and state guidance says you can't have 2 or 3 people in a room anymore.
Right.
That would make sense that all of a sudden your available bed numbers came down. This will be available beds, not necessarily utilized. And then also you may see some fluctuation between your normal medical beds and your critical care. So you may normally only have, let's say, 10 critical care beds, but all of a sudden, as a result of COVID-19, you have a brand new unit and you're converting some normal medical beds into critical care beds. So this number may all of a sudden jump while seeing a decrease in the other areas. So that would be expected. And then again, this is just for their own knowledge, just so they can see what our capabilities are going forward in case of a similar crisis, just in case they need to say, okay, well, in this particular area of the country, we only have this many beds available. So they may have to, in the future, possibly allocate more funding there. So they will be using this for data analytics purposes, but not in terms of your actual application forgiveness.
Right, and this information probably is not going to be subject to audit.
No, in fact, the compliance supplement, this is not listed within the reporting criteria for the auditor to evaluate. So your independent auditor would not be looking at this if you are subject to single audit. With that, we've jumped now back into the PowerPoint and looking at your single audit considerations. So just in general, a single audit is going to be required for those providers that expend $750,000 or more in funds in a period that corresponds to a provider's year end. We have a slide on the next slide. We'll go into more what that necessarily means, because HHS, their guidance on when to report doesn't necessarily correlate to your normal year end or the period that you're claiming expenses on. So that table will be critical in identifying whether or not you will be subject to single audit. For purposes of PRF, they're expanding expenditures to include both expenses claimed for reimbursement and lost revenues claimed. So those entities that may have undergone a single audit in the past, traditionally a single audit will only look at your expenses, but HHS is scoping in lost revenues as well in determining if you need a single audit. And this is going to tie directly back to what you report in the HHS portal. So we would highly suggest waiting on your audit, even if you determine it's necessary, until you do your reporting, so that when you do your CFA schedule for a single audit, it does agree back to what was reported. And also your auditors will have to take a look at your actual reporting. And then again, to reiterate, the period may not directly align with your year end. One good thing to point out as we start this is if you have a year end prior to June 30, 2021, so in this case, your December 31st, 2020, no amounts are going to be included at this time for determining a single audit. So you can finalize any sort of audit reports that may have been open because you had PRF funding. And then starting with year end June 30, 2021 through December 30, 2021, you're going to start having to evaluate whether or not you need a single audit. So for any fiscal year ends June 30, 2021, the period one submission you're doing now between July 1st and September 30th will be included on your CFA and will be what you evaluate against the $750,000 criteria. Also to point out is this will include all of your expenses and lost revenues from January 1st, 2020 through June 30, 2021. So it will not directly correspond to your year end. So if you are undergoing a single audit, we would recommend a footnote to just reinforce that in case you do have other programs, and just to specify that it will not tie directly out to the financial statements because you are using a different period. For those entities with a year end of December 31st, 2021 through June 29th, 2022, you're going to report the amounts on your period 1 and period 2 submissions. Again, you're really going to have a disconnect here in that you'll be including all your amounts that you're claiming for 2020 and 2021 on your audit report if it was a single audit. So you would possibly be undergoing a financial statement audit for 1 year, but also have a compliance audit for 2 years. So there is a slight disconnect there. And then as of now, for June 30, 2022 and after, they have not provided any official guidance on what will be included on the SEPA at this point, but we do expect the 2022 compliance supplement to cover that. In terms of timing, just in general, the compliance supplement usually comes out the first or second week of August. If you do Google it, you will be able to identify that. The good news is for 2021, the program is currently included and gave very clear guidance, so there's no question marks this year on what to do with the Provider Relief Fund. So the next piece here is what type of audit is required. Currently, the industry is saying there's going to be split between what a not-for-profit and government entity is going to have to do and a for-profit entity. To start with the for-profit entities, at this time, the expectation is that HHS is going to provide supplemental guidance to the compliance supplement to determine what you're going to need audited versus using the compliance supplement. At most, they're going to require the same thing as the compliance supplement in that you'd have to do a compliance audit on how you spent the funds, whether you calculated lost revenues reasonably, and that your reporting matched what you did on your provider relief portal versus your financial statements. The expectation is if there's anything that's going to cut back on, it's possibly not requiring you to undergo a financial statement audit. But at this time, there's no official guidance there. We would recommend you do have the same sort of documentation and policies for costs and expenses ready to those that are receiving a single audit or a program audit, just because there's going to be some sort of review of your compliance. So on that end, if you do have the reports ready, it just makes it a lot easier if and when you begin getting audited. For your not-for-profit and government entities, these audits will be conducted in accordance with the 2021 compliance supplement. Providers may elect to receive either a single audit or a GAGAS financial audit or program audit. We'll cover the difference on the next slide between those two. Providers will be ineligible to receive that program audit if you received funding from more than one federal program. So some other programs to be aware of that may kick you out of the eligibility for a program audit would be if you did get an EIDL advance and received it between July 1st of 2020 and June 30, 2021. For those that are a fiscal year June 30 entity, that did have a assistance listing number with it that would be required to be reported. So that would be additional federal programs. Same thing with the COVID uninsured program. And then we mentioned earlier, if you got money from your local and state government, there's a possibility this was passed through coronavirus relief funds. I will say the caveat here, if you did receive any money from a county that was coronavirus relief funds, is reach out to your agency as soon as possible, because this funding itself is unlike any other that's been given out, in that the county has to make a determination of whether you were a subrecipient of the money or a beneficiary of the money. So as a subrecipient, that money would be reported on your SEPA and would kick you out of the program audit. But those that are considered to be a beneficiary would not have to report it for single audit purposes, and that would not cause you to get a single audit. The other thing here is that if you have PRF funding of $700,000 and your COVID uninsured program is $50,000, that would meet the $750,000 requiring the single audit. So that's why, again, it's very important if you did receive any money from the county or a state, and it's for the coronavirus relief fund, to identify whether you are a subrecipient or a beneficiary. I have seen one client that received this directly related to upgrades to the facility because of COVID-19. They were reimbursed by a county for that. So if you had something similar, it is possible that was coronavirus relief funds that were passed through.
James, do you know the COVID-19 uninsured program? Is that where they received money, for instance, for Medicaid patients for COVID testing?
Correct,
Okay,
yes.
that's what I thought.
So again, to reiterate, the 750 is all your federal programs. So even if PRF was under 750, try to evaluate the whole picture with all the funding sources. So what is a single audit? So you'll see 4 things here. You'll receive an auditor's opinion on the presentation of your financial statements and whether they're presented in accordance with generally accepted accounting principles. Your auditor is going to look at your internal control over financial reporting and on compliance and other matters based on the audit of the financial statements. So what that means is they're looking at whether or not you complied with significant awards. You're going to get a report on your internal controls over compliance required by the uniform guidance. And then finally, an audit report on compliance with each major program. The other option you'll see here is a program audit, which is less cumbersome in that you're not having your actual financial statements evaluated or the internal controls over financial reporting. This would just be limited to looking at your controls over compliance and the compliance with the program itself. From a time and cost perspective, this would be a much cheaper option. Entities do have the option to elect a full single audit if they do want to go that route. If you are looking to save costs on your end as well as time, the program audit, if you do qualify, would be the cheaper and less time-consuming option. Right now, based on the 2021 compliance supplement, there's 4 areas they're going to have us as auditors look at that would be subject to testing. So I'm just going to read based on what the compliance supplement said for each of these areas. They should sound pretty familiar as it does mimic the guidance within the post-payment notice and the frequently asked questions. So activities allowable, their definition is funds used to prevent, prepare for, and respond to coronavirus domestically or internationally for necessary expenses to reimburse to grants or other mechanisms eligible healthcare providers for healthcare-related expenses or lost revenues attributable to the coronavirus. So that's in line with the definition that they gave in post-payment notice number 5. And then for the infection control payments themselves, slightly different definition. They say that the costs there have to be either costs associated with administering COVID-19 testing, reporting those test results, hiring staff for either patient care or administrative support. In that case, administrative support for reporting test results or for getting tests scheduled or setting up testing, improving your infection control, or even providing additional services to residents such as, let's say you set up computers and Skype so that they can reach out to relatives that they may not be able to physically contact. Those would be allowable expenses for infection control payments. For allowable costs, what they're highlighting is that you will not use uniform cost principles in terms of calculating the expenses. Instead, you will be using HHS's guidelines for allowable costs that they put out through their various guidance. The one big area, again, to point out is that you will be able to claim the gross cost for things and not the depreciation amount. So that should be a huge windfall for many organizations. And again, things such as equipment that weren't necessarily used. In some cases, if you were getting a regular audit and you didn't actually use something, you just put it in inventory, under uniform guidance, that may not be an allowable cost, but under the guidance they provided for HHS directly related to provider relief funds, that would be an allowable cost. So for reporting, the big thing here is that your auditor is going to take a look at your reporting submission and the key line items throughout, such as A, did you report all of your other assistants? B, was everything netted? So again, the easiest way to get question costs as an auditor would be if you see the source costs were charged to more than one area, that's the easiest way to get any sort of question costs. Reviewing to see quote unquote double dipping would be part of an auditor's procedures. They'll take a look at whether or not your 2019 base year was based on a reasonable numbers, whether your methodology was applied consistently, and whether the numbers in your lost revenue calculations agree back to your financial reports from your financial system. Included in that would be, if you had that budget that you used, your auditor is going to take a look at whether or not that budget was formally approved. So if you did report with a budget that was approved after the fact, there is a possibility they would have to question all of those costs. One thing that is carved out of reporting is your auditor will not make the determination on whether your methodology for the alternative reasonable methodology calculation for lost revenues is appropriate. That's a little bit of a concern in that if your auditor found it unreasonable, there is a chance that they would catch it now and you can use it maybe a different methodology later, or the question cost would be limited. Unfortunately, if they do audit you, HHS will make that determination. So again, there's the possibility that you have an exposure for more prohibited costs by using that method. And then finally, they did add a special test and provision along with this funding. Specifically, your auditor is going to have to test to see whether you billed any out-of-network patients additional money for COVID-19 related services or testing than you would have charged an inpatient for those same services. Because of the funding with PRF, they did not want you to charge out-of-network patients more money than in-network patients. That was supposed to be something providers would eat the cost of, and that would come through on your lost revenues. So if that is tested and it is identified as an issue, you may be able to retroactively adjust that for lost revenues. So let's say that you reported all loss expenses in period one in your fiscal year entity, and your auditor identified that as an issue. You would still be able to possibly fix it now in case you are going to use lost revenues for period two. And there won't really be a P&L impact with that because it would run through your lost revenues. But if you had previously reported lost revenues and that was included, that may cause you to have some question costs in that area related to those additional billings. So what should you do to prepare for a single audit? So several things we would recommend here is, first and foremost, keep a copy of your portal submission. If you did complete the template prior to going in and doing the portal submission, keep a copy of that and any sort of calculations you have on your end for lost revenues. For your 2019 numbers, have something that back those up, whether it's a tax return, along with internal financial statements and show how they tie back to each other. Or if you have a previous audit review or compile financial statement, have those ready to tie out the 2019 numbers. We would recommend either a report from your financial system that shows what you allocated to provider relief funding for expenses versus other reports, if you are able to do that by a class code or a separate department. And for those that aren't able to do something within your financial reporting system, what we would recommend is create an Excel schedule, list out all of the source costs that were related to COVID-19, and then go through and list out what fund each of those were charged to, and just reconcile that those source costs were not reported more than once. For any of the source costs that are allocated to provider relief, we would recommend keeping copies of the approved invoices, pay registers, and any sort of timesheet, effort reports, or time policies handy to support your numbers, because ultimately when your auditor does come in, they are going to ask for a sample of those costs. And then finally, if you don't have these sort of policies that we're going to list below in place, have these sort of policies approved and in place by the time your audit begins, as this would be what an auditor would look at in terms of internal controls over compliance. So as best practice, you should have a cash disbursements policy, policies related to payroll processing, policies related to billing and collecting, including how you identified out-of-network patients and how you charge them when you were doing COVID-19 specific services, a documented conflict of interest policy, and then a policy related to how you come up with your financial reporting package that went into your PRF funding itself. And then just to repeat this one more time, when you go through and you're ready to submit, just double check these costs were not reimbursed by other sources, because you really only get one bite at the apple. So you could go through and claim those expenses twice by accident, and then you have question costs. But you may have been able to claim less expenses and go into the lost revenue calculation and still get full forgiveness and not have any question costs. So we would recommend double checking and triple checking to ensure you aren't double dipping on any of the expenses claimed. So with that, we are going to take questions now. Feel free, if you have any questions after this webinar, to either email our email at cares@brinkersimpson.com, visit our website, brinkersimpsoncares.com, or you can email us directly. We do have the URL here for the frequently asked questions for the Provider Relief Fund that HHS continues to provide additional information on as well.
Right, and as we said earlier, we're going to email everybody who participated today. Will be receiving an email with a link to the portal and also to the Excel. Well, not the link, the PowerPoint. This PowerPoint is going to be attached to the email, as well as the Excel spreadsheet. And within the PowerPoint is the link to the portal and the instructions for registering.
Yes.
So again, if you have to report by September 30th, please make sure you're pre-registered as soon as possible and start filling out your Excel spreadsheet, because there's a lot of information that's going to be required. Okay, we'll start with the questions.
And then again, we can only see questions that are in the Q&A box. So if you are going to ask any questions, we do recommend putting in the Q&A box, because we won't see anything in the chat itself.
Yeah, we see a lot in the chat, but we're not going to be able to access that. Will unused expenses roll forward automatically, or do you need to input them into the second and subsequent periods?
That's a great question. So right now we're expecting what's going to happen is the reporting period should capture those expenses and hopefully carry them forward into your next period when they open it up. There is going to be a 3-month lag, and with that, we're hoping they put that functionality into it. If that's not the case, as long as your reporting template, you do keep track of what went on to your previous reporting and what you're going to report for the next period, you should be able to just pick back up where you left off. But the hope is that functionality will be ready for period 2.
Right, but remember there's that tab where,
Yes.
where you're going to enter all the unreimbursed or over the unused expenses on that separate tab. So
yes, so when you do go in for period 2, you will be when you could use the same template and just pick back up from that other tab.
I'm sorry. We are paying sizable premiums for registry, sometimes 3 times normal cost. Do these fall under personnel costs? When you say registry, I assume you mean contracted labor, nursing. So yes, I mean, if you're paying extra registry, one, because you can't staff the facility because of COVID, and 2, because you need extra hours because of COVID, I would say yes.
Yeah, that's exactly what they want these funds being used for, is they realize that providers had these additional expenses, whether it's paying employees more money to just show up because they're on the front lines and they had a direct access to catching COVID-19, and they weren't going to come and necessarily work for the same wages because they were at risk. So those costs are definitely scoped into what would be allowable.
Okay, next isn't a question. It says this is overwhelming. Agreed. Agreed. This is overwhelming. sorry. I don't understand why assisted living would report 1 all the way across as the number of facility stays. Is that is defined as unique admissions?
So we're looking at in terms of number of facilities available to provide services, and then your actual admissions will go under inpatient on the portal itself. So if you have someone that is there for all 90 days, let's say of a quarter, it would just be an inpatient service for all 90 days in that separate area itself. So that's how we looked at it in terms of the data, the non-financial data section.
Okay, so I think we answered that. All right, that's it. Chat, or can we, no, we can't go to the chat? Oh, one more question popped up.
So how
That's a
good and
good question.
proactive is the communication from HHS about due dates, registering, and reporting? The recipients mostly know they are subject to this amount of compliance. They gave the terms of conditions originally.
Right,
They kind of hoped everyone would read it,
pay attention.
and they're not great if you aren't registered for the portal. They're not great at getting you any sort of changes to your either their requirements that they've changed or frequently asked questions or what has to be reported. When you do sign up for the portal, they are great in emailing you with any changes to the portal or frequently asked questions or guidance. So that's why we do recommend, if you have not done so already, to
Sign up.
register for that portal.
Okay, that's the last question that we have. Thank you, everybody who attended and who stayed till the end. We appreciate it. And I want to thank Lauren, who was our producer today. Good job. Thanks for helping James out.
thank you so
James and
much.
I out. And James, thanks for a great presentation.
Thank you, everyone.
All right, thanks, everybody. Have a great afternoon.